To outperform the Philippine Stock Exchange Index. The Alpha Opportunity Fund, as you can see here, down nearly 6% year to date. The line above the other versus the Philippine Stock Exchange, which is down by nearly 9%, as you can see on the bottom line here. Just comparing both, the fund is really outperforming the index. So let's talk to the manager of that fund. With us now for more from our Rockwall studio in Makati is Julian Tarrobago, the head of equities at ATR Asset Management. Assets under management at ATRAM are close to $2 billion. Good to have you with us, Julian. Thank you so much for joining us.
Morning, Kathy. Happy to be here. How
did you manage to lose a lot less than the benchmark? Which sectors did you invest in?
Well, yeah, you're right. It starts with, I think, sector, the sectors we're in. We are still quite positive on and exposed to property, consumer discretionary, and infrastructure. And the performance has been highly attributable to those particular sectors being resilient in this period of uncertainty in the markets. Also, I think the performance can be attributed mainly to being quite meticulous in terms of position sizing. We're very deliberate in terms of the bets, the size of the positions in each security, and this has resulted, I think, to a more balanced portfolio. If you look at the alpha generated by the portfolio this year, it's not because of one or two positions. It's actually more than 10 positions that outperform the index, and we've been, I think, blessed to have made those decisions this year.
So how did those positions, the 10 positions you mentioned, look like as inflation started to pick up to 5-year highs and GDP slowed in the second quarter?
Well, those positions have been, well, like I said earlier, very deliberately sized. It's a delicate balance of, I think, opportunity and risk. And one of those positions happens to be cash as well. So we're very deliberate with the cash. Right now, given the outlook, while we're very positive on the long-term outlook for the economy and the Philippine stock market, we do recognize the fact that there are short-term headwinds or uncertainties. So right now we're very slowly deploying.
What are the short-term headwinds?
Well, we've had a slew of disappointing economic reports recently. Lower than expected GDP numbers, higher than expected inflation, and you also have, as you mentioned earlier, in your commentary or your report, that there are external factors that have to be considered as well. So we're slowly right now deploying our cash as we'll hope, and we'll be more aggressive as we see signs of inflation easing.
So how much cash do you have now, and how much more are you willing to deploy before the end of the year?
We have about 8% in cash currently. We're looking to be, I think, if things happen the way we anticipate or expect them to happen, we want to be fully invested by the end of 2018.
So what's the best case scenario?
We're using the second half as a window. Sorry?
What's the best case scenario then, if things happen the way you want it?
The best case scenario is that the BSP is correct, that inflation is transitory and peaks in August or September, and then we can see a period of high GDP growth, low inflation, and we also believe that there's minimal downside on the Philippine peso. So that will also entice foreign investors to start seriously looking at the fundamentals of the Philippines and not worry too much about the currency depreciation.
Yeah, but there's the potential contagion of Turkey, and the financial crisis is happening there right now on emerging market currencies. So what impact could that have on the peso?
Of course, it raises uncertainty, and whenever there's uncertainty, there will be a period of volatility. But we're not overly concerned about those matters. I think we've seen worse in situations wherein there have been far graver economic consequences. This is something that happens every so often, and the strategy is managed according to these external and domestic uncertainties or conditions.
Back on the consumer discretionary, why did you stick with that sector when inflation's pushed people to spend more on basic goods than on purchases that they could postpone for another time?
Well, we think that the demographic is still very favorable for consumer discretionary spending, and we think that ultimately incomes will go up. We have a very young, productive population, and there are certain ways of playing that particular theme. Companies like Wilcon, for example, have registered fairly decent returns for us. And there are others out there that we're quite positive on.
Now, I see that you're in property but not in banking. But the last time we talked, banking was in that list. Now, both are interest rate sensitive sectors. So why the change and just focusing in on property right now?
Well, we just calibrated our position in banks a little bit lower because we think that while theoretically speaking, higher interest rates should result to net interest margin expansion, we do recognize the fact that there is some competition in terms of funding costs for the banks. So that we think will limit, at least in the short term, expansion in terms of net interest margin. So given that, we think the upward trajectory of ROE may be delayed a little bit further, and that's why we're relatively less positive. We're not negative on the banks. We're still quite positive on the banks. We're just less positive.
All right. Well, thank you so much for that assessment. I hope you keep outperforming the index there. Julian Tarrobago, the head of equities at ATR Asset Management in Makati.